Good morning, everybody. This is Greg Freeman from Freeman CPA, welcoming you to another great segment brought to you by Atlanta Business Accountants. Remember, here our motto is your success is our success all day, every day. And we today are going to be speaking about partnership taxation, learning about partnership taxation. Remember, partnership taxation is one of the most complex areas of taxation. So we want to make sure that our clients understand what they're getting themselves into. And this client is actually exemplary because what she's doing is she's reaching out to her tax professional way ahead of time. They're starting up this partnership, this LLC, mid-year, and they're already doing all the legwork. They're hiring attorneys, speaking to their tax accountant, doing research, looking into things, trying to understand what exactly they're going to be getting themselves into. So kudos to you. This is an amazing effort. I love to see this kind of effort from our clients that actually reach out and are proactive and are ensuring that they succeed and that they do not have any issues, any unforeseen circumstances that they could have mitigated by doing their homework ahead of time. So great job, guys. Keep it up. All right. So, and by the way, this is exactly how you want to reach out to your tax accountant when you're looking into something or something's happened. And what you want to do is give a little bit of a background as to what the case is. Then you want to spell out what you already know, what you've already looked into, how you've educated yourself to what degree. So that gives me an idea of what this individual is looking for, what kind of guidance they're looking for. Because remember, partnership taxation is complex and it can go in many different directions. So I can be here guessing for a long time. So we want to be as concrete as possible. And doing your own homework and coming up with what you know is an excellent way to start. And then what are some of the specific questions that you have, right? And obviously, my job is to have the foresight. I've worked with many partnerships over the years. I've done a lot of continuing education about partnerships. And I've seen many different situations in the last 20 years. So I'm definitely going to bring to the table what I already foresee, what I've already ran into as a professional, and basically try to bridge that gap for my clients and give them the tools that they need to make sure that they're not going to run into those issues. All right, so why don't we just jump right in? So the background is quite straightforward. My client and her colleague are starting an LLC, and for tax purposes, when you have more than one member in an LLC, that's considered a partnership. Her colleague is closing her LLC, which is a sole proprietorship for tax purposes, to open up this new venture together. So that's exciting. Great job. We always love to see partnerships take off. And it's a very exciting chapter in anyone's life. What she knows. So I know that according to the IRS, an LLC is considered a partnership. And I'm going to just run through what she knows and the questions she has for our firm. And then I'm going to come back and address everything one at a time. I also know that according to the IRS, partnerships are considered pass-through entities, meaning any income earned by the business is taxed once at the personal or AKA partnership level. Partnerships do not pay income tax. Partners are not employees, so a W-2 is not issued. The self-employment tax rate is 15.3%, and there can be an additional Medicare tax. Per the IRS, each partner must report an annual information return to report income deductions. Okay, questions for me. If we start our business in May 2024, does that mean our fiscal year for LLC must be from May 24 to April 25? Or can they do like a regular January through December? Great question. Well, I understand each partner will file Form 1065. Can you help our business with these forms at the end of the tax year? If yes, what will be the estimated cost? All right, I'm going to leave it out in my answer about the estimated cost because that's private and confidential to our firm, and that will be a separate conversation. Could you also help us file the new BOI form at the end of 2024 tax year? What would be the estimated cost? Again, I would leave out the estimated cost, but I will address how our firm is planning on handling the BOI. Other than the self-employment tax that I discussed above, are there any other tax rates that I need to consider when I am trying to pay estimated tax on my pay? Very good question. We will not have employees tied to our business. Do the owners of the LLC have to complete Form 5305 SEP? If we are saving for retirement, I review the form and I don't understand it. It seems I need to commit to giving myself a certain amount of money into a SEP IRA retirement fund. Can you help me understand if my partner and I need to complete this form? Yes, absolutely. I will go over this. Is the 15.3% self-employment tax rate applied to each time I pay myself from the business? For example, if I paid myself $2,500, would I pay $382.50 of estimated tax to the IRS? Great question. Also, if I want to put money into a SEP IRA for my pay, should I pay an estimated tax on what I'm contributing to a retirement account? Thank you for your help and understanding. Wonderful, wonderful. I absolutely love this. This is my favorite topic. So why don't we jump right in? What she knows. And so the first question is, I know that according to the IRS, an LLC is considered a partnership. Okay, not exactly. So an LLC is basically if I don't know how, well, actually, I should know how old you are, but if I'm addressing all the viewers out there, if you're old enough and you've seen the movie Planes, Trains, and Automobiles with Jim Candy, and I forgot the other comedian's name, but it was a really funny movie, and they're going across the country in a plane, train, and automobile. And that's exactly what an LLC is. An LLC, okay, is actually a one-size-fits-all type of entity. It's a great entity to start with because it literally can be converted to a plane, a train, or an automobile. So if you have just one member in your LLC, then that's considered a single-member LLC or a sole proprietorship for tax purposes, a disregarded entity for tax purposes. So there's very little distinction between the individual and the actual entity. Everything's reported very simplistically. There is no separate reporting. It's just a business schedule, perhaps, or a rental schedule, depending on what the activity is. But it's still part of that 1040. If there's two members in the LLC, two members, then yes, it is considered a partnership. Okay, but you can also start an LLC with two members or even one member and convert it to an S corporation. You can also convert it to a C corporation. And you can go back and forth. And so that's the beauty of the LLC. Now, the LLC also has specific legal privileges that are different from like a corporation. So depending on what you're doing and where you're doing business and all of these other parameters, it will greatly, it might greatly benefit you to start out as an LLC because an LLC in Delaware might have very different privileges from an LLC or an S corporation in, let's say, the state of Georgia or Florida. It will vary greatly. So that's an attorney question because you want to understand how much legal protection you have with an LLC versus a corporation and where it's being formed. So we see a lot of the time small ventures start up in Delaware because Delaware has very specific laws that offer certain types of protection to the members of the LLC. And that's why they might start out as an LLC, convert it to a C Corp, or what have you. Because Delaware is very specific. So that's a good little nuance there for you to also consider when you are speaking with your attorney as to, besides tax purposes, there's also legal purposes, and you want to make sure that you're covering all your bases. So the LLC gives you one set of, and again, I'm not an attorney, so I can't advise you on this. I've just seen this in practice. But if you're doing a consulting business, something like this, I think it'll be just fine. Doing an LLC in your state and just doing a partnership, that's very common. But just know that, if you're starting off as an LLC for tax purposes, you would be considered a partnership. So you are correct. And, partnership taxation is different from S corporation taxation, and it's different from C corporation taxation, and they're treated completely differently. Tax laws are completely different. Where a partnership has a lot of flexibility, an S corporation doesn't. And where partnerships receive no W-2s, S corporations do, and so do C corporations. And the difference between an S corporation and a C corporation are also great. Like the way they're taxed, everything's completely different. Like C corporation has double tax. and it has a flat rate, whereas S corporations are treated more like partnerships. But there's a reasonable compensation here. So there's just a lot of big differences. Okay, but just know that an LLC can literally fit into any one of these categories and then jump around which way, as long as there's proper authorization, it can definitely do that. So when you think of an LLC, I want you to think of planes, trains, and automobiles. Like one of my favorite comedy movies that allows a lot of flexibility and also probably offers a lot of great legal protection. So it's a great way to start out. And we do see a lot of people start out as LLCs and then convert. We have both kinds. We have partnerships with LLCs, and we have that are treated as LLCs as partnerships for tax purposes, and we have those that are S corporations. And there's differences for tax purposes. Big differences where an S corporation, you actually get a W-2, and you have to give yourself a W-2, and some people prefer that. And I can point you to some videos where I discuss differences between S corporation and LLC, because that self-employment tax will play out completely differently for an S corporation versus an LLC. So if you're a partnership, if we're assuming that both partners are general partners, all of the profit is going to be subject to self-employment tax, the SE tax. Okay, whereas with an S corporation, only the W-2 income is subject to SE tax. Now, the way things work is also, you're getting those W-2s for the amount of earnings that you have, and you're regulating how much W-2 income you have. So it really changes the playing field with an S corporation. Whereas with the LLC, you're kind of both entitled to 50-50 or however you guys have split it. So there, it can really be a little bit more detrimental in a way, because legally you might be entitled to 50% of the profits, but maybe you didn't do any work for it. So that's another conversation to have with the attorney, because that's a big issue for some people. Like they have that partner. Think of the partner in a bar business where one partner is just a drunk or something like that and doesn't do any work, and the other partner is doing all the work, but he's still entitled to 50% of the profits legally. And so that comes up often in business as well. And I've actually heard of attorneys that said to me at one point that it's easier to have a divorce than it is to get rid of a bad partner. And this can be true. And I'm not an attorney, but I'm guessing that that attorney really knew what he was talking about, because I guess from experience. But any which way, not to jump off tangent. So I hope that helps really solidify a little bit more what's the big difference between this, LLC and corporation or C corp. So if you're going to open up an LLC, to answer your question and to point you in the right direction, and it's going to be treated as a partnership, then I would still discuss with the attorney, what exactly am I entitled to? What happens if my partner brings in less money than I do? And we agree to split everything 50-50. Getting to that next point, you have to get a partnership agreement in place. This is so important. In partnerships, just an agreement between individuals, I believe, is considered good, but you want to put everything down in writing. And the reason you want to do this is because you want to spell everything out. Partnerships really come in two different flavors: the simple flavor and the complex flavor. So the beauty of the partnership is that you can really arrange for everything in so many different ways, where an S corporation is kind of more solidified, whereas an S corporation, distributions have to be equal. Okay, but in an LLC, you can literally allocate things in any which way, and that's really more of the complexities of the partnerships. Is that you can, it's like, if you want to make it happen, you can make it happen on any any level. You know, you can say we'll split profits 20-30, and then we'll do equity 50-50, and we'll do, if we have losses, we'll do 10-90 split. And there's just so many different ways to allocate so many different things, and you can really allocate anything in any which way as long as your imagination fits it. It can really be done. That's how flexible the LLC is. And so coming back to that partnership agreement, it is so important for you to get that partnership agreement down and get a good attorney that has a lot of this experience with partnerships and business, because you want to really spell everything out. A simple partnership is going to literally be 50-50 everything. And the way things are split in a partnership is profits, losses, and capital. Okay. And you can split these differently, right? So you can have a 50-50 split for your profits. And like I said, you can have a 30-70 split for in case you have losses. And you can do even 0-100. I'm sorry, not 200, 0-100 contribution to capital, where one partner gives sweat equity and the other one brings in the money and one has experience. I mean, it really can be divvied up so many different ways. So that's all spelled out in the partnership agreement. And if you do 50-50 across the board for all of these three categories, then just know that you're not stuck with that, and you can amend the partnership agreement every year to better fit what actually happened. But you know, that the simpler, the better, because once you start allocating things and really splitting hairs, it will get very complicated very quickly, and you don't want to go down that route. And that's why some people are better off with like starting an LLC but converting it to an S corp, because things are way more solidified, and you're just basically getting a W-2 for the efforts you're putting in, and then you have to split up distributions based upon your percent share. Okay, so it's a little bit more solid now. And again, that's still, you know, legally you have to understand what is an S corp. So if the other partner did so much less work, you know, how much do they really get in profit distribution as well? All right, and again, we can keep going. There's really a lot to know about that first point, as far as that the LLC is considered a partnership. Yes, it is considered a partnership if you so elect it, but I want you to know all of this as well, because these are very important things to understand, and these are very important aspects to consider before you decide that you want to be in a partnership, because there are not only tax differences, but great legal differences as well. All right. I don't think I'm missing anything in that first point, where my client asks, according to the IRS, an LLC is considered a partnership. So to, again, address that, yes, if you so elected. Two, I also know that according to the IRS, partnerships are considered pass-through entities, meaning any income earned by a business is taxed only once at the personal level. Partnerships do not pay income tax. That is correct. Partnerships do not pay an income tax. And everything. So here's your if this box represents your LLC, then and this box represents partner A, and this box represents partner B. This is exactly what it would look like. Okay, so one Form 1065 for the two of you. Okay, and just insert a row. All right. Let me get a little line here. Oop, wrong line. And another line there. So this line represents how the income would flow from the 1065 to partner A and to partner B. So this little line here and this little line here. Let's say you had profits at a 50-50 split. 50% of the profit would flow like this, and 50% of the profit would flow like that via Form K1. Okay, so this is This is the form that looks like basically like a form like this with a lot of little boxes on it. Okay, so this would be form K1. All right, and each partner would receive one. So each partner would receive a K1. And all of these little boxes on that K1 form are for tax items that are passing through. So if this first box is income from business and you're splitting 100,000 50-50 each, partner one would receive 50,000, and then if this is K1 partner A, right? And then let me just move this over here. Right? So, and this would be partner, rather, this should be really partner B. So this is what it would look like. So you would have each, so the 1065 produces this form here. Right? And then the 1065 produces this form here. Like this. So this 1065 would produce a K1 for 50,000, and that K1 would actually feed back to this partner, like this, right? All I'm really missing is an arrow, and forgive me if I don't know how to do arrows right now. I'm not going to spend the time, but you understand how this is flowing, right? So just like that. All right. And of course, there's all these other, what we call separately stated items, because a partnership can have many different things. Usually, in a consulting business, all you're really going to have reported is your profits on a 50-50 split. There'll be some other boxes that explain how much your profits, losses, basically your ratio allocations. So you'll have like a capital section where it says profits, losses, capital. And what's the split like if it's profit 50-50, and if it's a very straight, like the way I would set it up is basically like a 50-50 all the way down the middle. And again, this is an attorney question, but just to give you an example of what like a typical partnership would look like, it would report that. Here it would report like in box 14, it'll typically tell you how much of this income is subject to self-employment tax. All right. And so on. So it has a lot of little boxes, a lot. And all those boxes have tax implications and meanings that need to be fed into your personal income tax return via this form K1. And that's where it all plays out, just like you said. So it'll all basically carry into its specific fields where it needs to go on your personal tax return. And from then on, it is basically just playing out on a partnership level, as we say. So if this is 50,000, that's subject to, all of it is subject to self-employment tax. When that self-employment tax input is fed into your 1040, your personal income tax return, the rules play out there. And depending on what your situation is, which might be vastly different from your partner's, will ultimately determine how much self-employment tax you're paying, if any, and so on and so forth. Now, again, we're going under the assumption here that you're both going to be general partners. I don't know that. Only general partners tend to have self-employment tax implications, and we have a great video that my partner Angie put together on how to minimize the self-employment tax if you're a partner in a partnership. But that's a very rare case. It's usually when you have what we call limited partners, okay? Limited partners are basically just investors, and they really have no, what's the word I'm looking for? No participation in the business, and they're really just silent investors for the most part and do pretty much nothing but maybe put up some money. So again, I don't know what your partner is going to be doing, but I'm just going to go under the assumption that both of you are going to be general partners and that both of you will receive a 50-50 split or something along these lines where things are pretty straightforward and we're looking at a simplistic partnership. And then both of you will have self-employment tax implications once that profit hits both of your tax returns, and how exactly that will play out will depend on other variables on your tax return. So I'm going to dive into that when I address those questions down below. All right, so this is exactly how partnerships work on a partnership level. Okay, so when we're dealing with partners, they are the ones that pay the income tax. The partnership does not, so you are correct in your assumption. The partnership does have annual filing fees and all sorts of payments that it has to make. It depends on where you're doing business and which state you're in, because some will have different implications. Like the state of New York and New York City, there is an unincorporated business tax where the partnership doesn't pay anything for the federal income tax because it's a pass-through entity, but New York disregards that. New York City says, I don't care. You're in New York City. You have to pay an unincorporated business tax because, we just need money. And depending on how much money you have, that's 4%. At least it used to be. I haven't done a partnership, New York City partnership tax form in a long time, but I used to. When I worked in Broadway taxation, a lot of the Broadway shows are all set up as LLCs because foreign owners can be owners of an LLC, whereas S corporations cannot. And so these are huge partnerships. I mean, there's, the production costs in Broadway shows are astronomical. And they need the money to come in from all over the world. And so there's a lot of partnerships. They're all partnerships. There's a lot of partners. And then they have to pay this unincorporated business tax because they're not a corporation for tax purposes. And New York City just wants money. So it says, we don't care. And that would be a hefty amount of money. So in a way, yes and no, right? So in our world, everything will always depend on something. There's never like a yes or no. If any tax accountant ever says yes or no to you, they don't know what they're doing, because in our world, the most common response to everything is it depends. It literally depends on your situation, where you're at, what's this partnership doing, and so on and so on and so on. Unfortunately, there's never a straightforward answer. Just know that every single LLC will have an annual fee to the state that they're formed in. And that's just like, it's not an income tax, but it's hey, you have the privilege of having an LLC in our state. Where's our annual dues? So Florida has that. New York has that. Every single state has that. It's a franchise tax of some kind. So it depends on where you're at, where you're doing business, and so on and so forth. So no, there is no federal income tax, but there are other miscellaneous fees that you might incur to your state of formation. And Delaware is different, by the way, from Florida and so on. And there are penalties and late filing penalties, and you can lose the business standing if those aren't paid on an annual basis. So it's important to know where you're forming your business and understand what you owe. All right, point number 3, partners are not employees, so W-2 is not issued. That is 100% correct. It's illegal to do so. And if you do that, you're actually changing the mechanics of how the taxes work, and you actually will cost yourself more money doing that because you're breaking the mechanics and you're going against the grain. Have I seen it in practice? Yes, I have seen it in practice. It's done sometimes. People just do it because they want a W-2 and they don't care. and it's technically illegal, but it's not like you're breaking the law. You're actually costing yourself more money in taxation because of the way the mechanics work. I'm not going to go into those details because it's highly complicated. But just understand that no, you will not have a W-2 unless what? Your LLC elects S status, in which case you will get a W-2. So that's important to know because some people want a W-2 because lenders for mortgages and all sorts of other places want to see a W-2. Unless you're working with a lender that specializes in small business and knows what a K-1 is, which sometimes is just easier to show a W-2 from a business that's been established. Some lenders give it a hard time, and they just they don't treat it as favorably because there's no formal W-2. They just want to go down a checklist and check off that there's a W-2, and that's how that works. And that's why I've seen people in very big partnerships give themselves a W-2 for that reason alone, even though it's costing them more in tax. So anyway, so otherwise, yes, you are correct. Now here's number 4. The self-employment tax rate is 15.3, and then there's an additional Medicare tax. Yes and no. It depends. Again, this $50,000 would not be automatically charged 15.3%. Plus, if there's an additional Medicare tax, why? Because Social Security has a cap. So let's talk about what is the self-employment tax. So the self-employment tax, and I'll link a video where I discuss what self-employment taxes are, but it's basically Social Security and Medicare, and each one is, this is 0.062, and this is 0.0145, and together it's 765. Okay, but since you're considered self-employed for tax purposes, it's the same as you're the employee and the employer at the same time. So they multiply that times 2. And that's your 15.3% that you're referring to. So great job in understanding that. But just know that if you're still working on a W-2, the Social Security has a cap. And my memory is awful these days. I think it's like 140,000. Let me just quickly Google that. What is the Social Security cap 2024? So the Social Security cap is 168. So 168K for 2024. This is pretty big. I can remember when it was in the 90s, So what does that mean? So basically, if you're on a W-2 from somewhere else, if you're receiving a W-2 from somewhere else, and you're working on a consulting on the side, and let's say you've already received 200K on your W-2 from your other job, you will not be paying the Social Security tax in full again, because it maxed out at 168. So if you receive $50,000 here from your LLC, and you've already received 200K from your W-2, you will not pay any more the Social Security because it's capped at 168K. So this $50,000 would only be taxed for the Medicare tax, if you see what I'm saying. So that's very important to understand because we can't ever, and this is why we could never give like blanket advice and say yes or no. And this is why we say it depends, because of these laws and because of these rules and because of these caps. So if we don't have this situation, then yes, technically speaking, you will be paying 15.3%. But again, I'm going to say technically no. Okay, and you're going to say, well, why? Well, because of the way the mechanics work. When this self-employment tax hits your tax return, when it's passing through, it will actually come into a schedule called Schedule SE for self-employment tax. That schedule is designed to check, first of all, to see if you have other income that's already been taxed for Social Security, and to take that into account, 1. 2, it will reduce this number to 92.35%. So there's a reduction to 92.35%. Okay. And that, so if you earn $50,000 It's going to take 50,000 and then multiply it by your 92.35%. And it's only going to tax for the self-employment tax 46175. Then it's going to apply that 15.3%. So what, in a simplistic fashion, what is your self-employment going to look like? It's actually going to be $7,064. It's not going to be 15.3% times 50,000. It's going to be 15.3% of whatever 92.35% is of $50,000. Okay, that's really important to know. That's one. But yes, this is the self-employment tax in the simplistic way that you'll be paying. Okay, but you're also going to be receiving 50% of this self-employment tax as what? As an adjustment to income. Okay, so now you might be asking yourself, well, what's an adjustment to income? So guys, let's go back to the good old, let's learn how taxes work on your 1040. So if this is your if this box represents your Form 1040, where you file your income taxes each and every single year, right? What's the formula? What's the, when I went to school for accounting and the very first, accounting tax class I had, we learned the basic tax formula. And it's so simple. So once you understand how the tax formula works, then you can expand upon it and learn all the details. But it's really a quite simple system. Okay, so you have gross income from all sources. Then you have what we call adjustments to income, or AKA deductions. Right, to arrive at adjusted gross income. So if my gross income is $50,000 from that partnership, then I get an adjustment or deductions from income to arrive to adjusted gross income. And what are some examples of those adjustments to income? Well, the first great example that I can think of that is relevant to this conversation is 50% of the self-employment tax. So minus this number right here. What's another great example? A SEP IRA contribution. All right, and that could be, let's say, 20% of this $50,000. So if I wanted to max out my SEP IRA, I can do, let's just say, a hypothetical $10,000 to arrive to my adjusted gross income. Oops. So my adjusted gross income is going to be $36,467. Then I receive a standard deduction. I also receive a qualified business income deduction of another 20%, right? Equals this. And again, this I'll link some videos for the QBID times 0.2. And let's make this also a dollar sign. And let's make this a negative. And if you're single, let's just say, I don't know what the rates are, but standard deduction 2024. So single filer is 14,600 minus 14,600, and the formatting to arrive to my what we call taxable income. Equals this plus okay, so my taxable income would be 11,670 and this would be 10% income tax. So my income tax in a simplistic form would be 10% of this equals this times 0.10. So I'd owe only $1,100 plus my what? My self-employment tax, right? SC tax. So my total tax is this plus this. And that's what I would be paying in taxes. Okay? So this is basically how that works. Now remember, your 1040 has many different types of taxes. It's not just income tax. It's not just self-employment tax. You can also owe excise tax. You can owe an alternative minimum tax. You can owe capital gains tax, right? You can owe like so many different types of taxes. If you go look like the additional Medicare tax or the net investment income tax. So there's just tons of different types of taxes. If you're old enough and here's another movie reference for you with Robin Williams, Popeye, I think it was like 80 something. If you're old enough to have seen that movie, it was a great movie. Robin Williams did a great job in emulating Popeye the Sailor Man. And he gets off the boat, and like the minute he steps on shore in this town, there's the tax collector, and the tax collector is walking around, and every little thing that Popeye does, the tax collector is taxing him. He's like, oh, and a breathing tax, oh, and a spinach eating tax, oh, and a dock fee tax for the boat, and walking into a bar tax, and walking into the saloon tax. Everything that Popeye did, the tax collector was there and giving him a tax for everything except for breathing, which is probably very indicative of our tax system. So your 1040 kind of brings it all into like this one form where depending on what you have, it'll trigger all these different little taxes. Some big, some small, some medium, some large, and they're all kind of playing out these different rules depending on what you had going on. If you sold your home for a certain amount of profit, you'll have a capital gains tax, which is a favorable tax. And if you're really, really, impoverished and don't have any other kind of income, you can literally pay zero taxes that year because capital gains tax can be as little as 0%. That's why there's strategies out there that leave money to the grandmother or to the elderly mother that has no other income because she's fully retired, and she'll pay zero in capital gains tax, or what we call the income tax. I mean, just think about the 1040 as where all these taxes happen. We have income tax, capital gain tax, self-employment tax, net investment income tax, additional Medicare taxes, excise tax, and on and on and on and on. So it really just think of it all as tax, your tax bill. What exactly, which part of that really makes up your total tax is irrelevant. Okay? Because when you're going to be sending in your estimated income taxes, we're not going to specify to the tax authority that some of my estimated tax payment is due to capital gains, and some of it is due to net investment income tax, and some of it is self-employment tax, and some of it is just regular income tax. They don't need all that information because that's all spelled out on your tax return. So when you're submitting your estimated income taxes, you're just submitting what you estimate your total tax bill will be, or what this total tax is going to be. Okay? So that's how this works. And if you think about it this way, all of a sudden your taxes become super easy to understand. All right. So that's my explanation of your fourth point as to the self-employment tax rate. I hope that really helps clear all that up. Per the IRS, each partner must report an annual information return to report income deductions. No, that is not correct. There is only a 1065. There is one 1065 filing, and that is just one partnership. There isn't two partnerships. There's just one partnership with two partners, as I described before. So you're pretty close there, but everything is reported on this 1065 form. If we go back to my first depiction here, That's your informational return, what we call an informational return, because you're right, it doesn't pay any income taxes. It is just an informational return where all the income and expenses and separately stated items are reported and allocations are performed. And. And by the way, speaking of all that, very important tip for you. When you do go to your attorney, I will have some tax specific verbiage that should be placed into your partnership agreement that will allow for what we call unreimbursed partner expenses that should be divvied up on a personal partnership level. For example, your automobile, for example, your home office, for example, your out of pocket expenses, right? For example, your home, did I say home office? Automobile, all these personal items that go unreimbursed out of the partnership. Because think about it, if you're the one that's driving, right, you want those expenses to be recouped on your personal return. You don't want it to be fed through the partnership. You want to recoup those on a personal, individual level where it plays out, and we call those unreimbursed partner expenses, or UPEs. And in order for you to be able to declare those properly, there has to be specific verbiage in the partnership agreement that spells that out. Why would you want to share your personal expenses with your partner? You wouldn't. You want your cell phone to be recouped only to you because it's your expense, right? You don't want to split that 50-50 with your partner because it's yours. Unless, right? But that's how it's typically handled. So you want to have that that wording in there, and we'll get into that when we're working with you specifically. But just know that it has to be placed in the partnership agreement. Okay. And again, so once that Schedule K1 is fed into your personal 1040, it's actually being reported on what we call a Schedule E, page 2. Okay. So remember, your 1040 is just this is the first page of the 1040, but depending on what you have, there will be a bunch of other sub-schedules, reporting everything separately. So if you had capital gains, you'll have a Schedule D, right? If you sold that house that I was referring to, you'll have a different form, a different schedule, which will basically reflect everything that happened with that house. How much you bought it for, how much you sold it for, what were the improvements, what's your total other income and everything. And then all these calculations will come into play on that first page of your 1040, depending on all these others. So there's a lot of like mechanics and moving parts that will impact the total tax that you're paying. Remember my example with your elderly mom that doesn't pay any income taxes on capital gains because she has no other income. And that's how capital gains work, right? They're favorable to the taxpayer. You can pay as little as 0% or 20%, depending on your total income and what kind of, what's your tax picture like. And again, and then you have the Schedule E for rentals, right? If you're in the business of renting something like a house, you'll have a Schedule E, which is profit and loss from rental activities. But Schedule E also has a page 2. Okay, and that page 2 is where the pass-through activity comes in. And against this, on this Schedule E page 2, where you have that information coming in, that's where you want to reflect those unreimbursed partner charges. All right, where your cell phone, your automobile, your home office, anything that you've incurred on an individual level that wasn't reimbursed through the partnership, that you're not going to split with your partner, is going to be reflected on that page 2 as a reduction against your profits coming in from that activity, from that partnership. Okay, so you're absolutely right. It is an annual information return that does report income and deductions, correct. As well as, again, just to recap, other separately stated items, depending on what they are. And it shows allocations and all sorts of other things. All right, so now let's get on to the questions. I probably already answered some of these, but if I have not, here we go. All right. If we start our business in May 2024, does that mean our fiscal year must be from? No. By default, you will have a short year, okay, that first year, and then you're just going to go on a January to December automatic, what we call calendar year. And if you want a fiscal year, which I don't know why you would want to, sometimes it's done for strategic purposes, but I don't think that would apply to you. and you're not like a nonprofit or anything like that where you want to match an entity. So you would just default right into a January to December. We elect that on the very first return, and you can always change it, but there's no need to. All right. While I understand each partner will form 1065, so I already addressed this. There's only one 1065 that is being filed. It is one partnership. Can you help our business with these forms at the end? Yes, absolutely. That's what we do. But then there's always a but. We would have to have you guys. We would have to have a special disclosure that there is a potential conflict of interest, and basically both of you would have to sign because you are my client, and I do also prepare your personal tax return. There are certain elections that can be done on a partnership level that can benefit rather. My apologies. That can benefit one partner over the other. Okay, so for example, depreciation is a great example. You guys go out, and I don't think that this will happen in a consulting business, but you go out and your business buys a $10,000 asset. $10,000 asset. Now, depending on, now you have partner A and you have partner B, and I'm partner A's tax accountant, but I'm not partner B's tax accountant, right? Or I have them both as my clients. It doesn't matter, right? So this asset, whatever that asset is, needs to be depreciated. And we can be really aggressive. Depreciation has also, it's flexible, right? So I can take, let's say, all of that $10,000 as a depreciation deduction in 1 year. Or I can take that $10,000 and split it into 5 years. And you might be asking yourself, well, how is this a conflict of interest? Well, let's say I only represent partner A, and I know that partner A needs a lot of deduction this year because they're expecting a high income tax year. You see where I'm going? Partner B might have very low income and doesn't need any additional deduction, but I'm on partner A side and I can say, hey, why don't we just go aggressively with this depreciation? I know your income is going to be high. Let's just take all of that 10,000 in this 1 year. So we're going to help partner A, but it's really going to hinder partner B because they're not going to benefit any. They might benefit in year 2 or 3 or 4 or 5. So for partner B, it might have been better to take this asset over the next 5 years as opposed to all in 1 year. And again, these are things that are done with the consent of all partners. So all partners have to say aye. And we don't do elections for our clients without discussing it with the partners because that's because of the conflict of interest. Okay, so just keep that in mind. All right, back to the questions. Could you also help us file the new BOI? No, unfortunately, many tax accountants are not going to be helping their clients do the BOI. There's a lot of discussion about this in the tax groups. Many practitioners are discouraged from doing this because there are a lot of legal implications that can come out of it, for one. And we can literally be dragged through the mud, for two. And for three, that would mean keeping track of a lot of different businesses for us and taking on a lot of responsibility that we just cannot, we do not have the capacity. So legal exposure, most likely going to be against our insurance policy. We don't know yet. And it would just be overly complicated for a small 2-person operation to handle. So unfortunately, I will have to defer that to some other service. Or most likely you can just do it yourselves. It's a fairly simple, straightforward form. And we will be assisting our clients with actual preparation, but we will not be involved in actually doing those. Okay, so we will give guidance, but we will not be doing it for them because then we can be litigated against. So let's jump right to number 4. Other than self-employment tax that I discussed, are there any other tax rates that I need to consider when I'm trying to pay estimated tax? So exactly back to my presentation, okay, if you will. So just keep in mind that your tax return has many different types of taxes. Where was I going with all of this? So when you get a 50% reduction of your self-employment tax, now you see why it's not 15.3%. So in practice, we've always said effectively it's really more like 11%. And why is that? Well, because we first reduced that 15.3% to 92.35 on your Schedule SC, right? For one. For two, even though you're paying self-employment tax of $7,000, you just saved yourself in income tax by your marginal rate here, right? So when you're receiving a deduction from your income for 50% of the self-employment tax, you just reduced your taxable income, right? So you're saving 10% here. So effectively, it's lower than 15.3%. I hope this makes sense because, and not to mention, you're getting a qualified business income deduction of 20%. So even though you're paying a bunch of self-employment tax, your income tax is being reduced by the self-employment tax, 50% of the self-employment tax, and you're also receiving a qualified business income deduction for being in business. Okay, so effectively, your income tax dropped dramatically, but you still have to shell out for the self-employment tax. Now, the self-employment tax is where people save money by converting to an S corp. Okay, because you're more regulating, and then you have to see the other videos I put together about the differences between LLCs and S corps, because that's like a whole separate education there. That's a really great conversation. People always hire us to understand what's the difference between an LLC and an S corp, because for some people it just makes more sense to be an S corp than it does in an LLC. It depends on their tax picture. Okay. So that's that. You won't have to file this 5305 if you open up am I trying? Okay, so to clearly and concisely answer your fourth question, when I'm trying to pay estimated tax, you have to figure out what your total tax is going to be for that year, and pay that in estimates. Okay, so it'll depend. There's no easy way to do that. That's a separate engagement where if you're doing tax planning with us, we're going to try to help guide you to make in the right amount of estimated income tax. And that can greatly change in the year depending on what's going on with you. So it's very not straightforward. That's why a lot of the time when we help people pay estimated tax, we're just doing the blind prepayment method of paying in prior year's taxes in this year as an estimate unless something dramatically changes. And in your case, something might dramatically change. You might completely leave your W-2 employment and go straight into consulting. And that would be when we step in and try to do something a little bit more customized and help you determine a little bit closer as to what's your total tax going to be. What is the total exposure that year compared to prior years? So let's say when you were on W-2, you were paying a lot of income taxes. This year might not look like that because you're doing a startup. You're leaving one job mid-year, for example. You're starting this consulting business. You don't know how much you're going to earn there or anything, and things are very much up in the air. In some cases, people go into a startup phase where they don't make anything for 2 or 3 years. We've seen that, and they start really becoming super profitable in year 4 and 5, like big time. But up until then, there's no need to prepay last year's taxes for them because they're expecting losses for the first couple of years while they're in the startup phase. Okay, so it depends. It's not straightforward. As you can see now, it's highly complicated. There's no easy answer. It all depends. It will all depend. And that's why you hire us to help you with those details. All right. Almost last but not least, number 5, if you're contributing to an IRA, a SEP IRA, yes, you can both do that. You would have to do that through a brokerage. It's very easy to do, very quick to do, and they'll take care of these forms. Don't worry about that. Your job is to earn the money and to decide how much you want to put away. And like I said, simplistically speaking, it's about 20% of your profits per partner. Okay. Is the 15.3% self-employment tax rate applied to each time I pay myself from? So you do not receive a pay. Remember, there's no W-2. You're basically entitled to your profits. So if you guys agreed to split 50-50 on those profits, then as you're getting those profits, you're going to basically pull 50% of it out after expenses, right? So you guys earned 100K, there was $20,000 worth of expenses. You're basically allowed, and this all should be in the partnership agreement. Remember, that partnership agreement, if you have a good lawyer, has to spell out a lot of things. That's why partnership taxation is complex, because it has to say, if there's profits, you guys are both going to take distributions of profit so many times a year after you tally it up. And if one partner takes more, then you do a catch up the next year for the partner that missed out, and so on, to make things fair and equal. So it's very common for partnerships to have one partner pull out a lot more money during the year. They're busy, they don't have time. And then what they do, once we do the accounting and we bring to light, how much each partner took, then they do a catch up the following year so that it's 50-50 or whatever they agreed to. So again, you're not getting paid. You're just taking profit distributions, all right? And that all should be agreed to way ahead of time. So if we're profitable in the first month and we made $10,000 in profit after expenses, after accounting has been done, I get 50%. You make the draw. That's how it typically works in partnerships, but it's not pay. It's just a profit distribution. There is no W-2. You literally just pull the money out of the bank. That's it. Do you pay estimated taxes? Yes, we pay estimated taxes in our tax system. It's a pay-as-you-go system. And if you have income that's untaxed and you expect a tax liability in the current year, you need to submit you don't have to, but you want to, because then you penalized for not paying in your estimates, right? So we want to pay those in quarterly as they have to be paid in. April 15th is the first quarter, June 15th is the second quarter, September 15th is the third quarter, and then January 15th of every single year is the last quarter to submit your estimated income taxes to the IRS in the States. Okay, that's how that works. It's not when you pull out the money, it goes by a calendar, but you can send them the money anytime you like. You pulled out the money, you can send them the money now. You can send it to them when the quarterlies come due, depending what your situation is like, depending on how much you think you're going to owe, and so on and so on and so on. These are all moving parts, okay? And we can discuss that once you're in business. All right, I also want to put money in a SEP IRA. Great, you can do up to 20% of your profits, give or take. Should I pay an estimated tax on what I'm contributing to the retirement account? The SEP contributions, as you can see from my presentation, the SEP contribution would be here. So it's actually saving you in income taxes. Okay, it's not, but it is subject to self-employment tax, right? Remember, it's a deduction from income tax, but it's not going to be a deduction from the profits of business. So you are paying self-employment taxes on the profits of business, but you're sheltering the income tax. And when you pull out that money in the future, you will not pay the payroll tax, the self-employment tax, Social Security, Medicare tax at that time, because it's already been taxed, just like your 401k. But you will pay an income tax because you sheltered it. Okay, that's how that's going to work. All right. So that's pretty much my presentation for you today. I really hope that helps understand everything much better in a very convoluted system that we're dealing with. I hope that this video presentation helps you understand partnership taxation and what to expect out of your new business in 2024. I wish you a lot of success in your business and in everything that you do here at Freeman CPA, where our motto is, your success is our success all day, every day. Don't you guys forget it. Again, this is brought to you by Atlanta Business Accountants, our sister company here in the outskirts of Atlanta, where we're currently located in beautiful, rural Monroe, Georgia, presenting to you once again on tax topics. This is Greg Freeman signing off, and I hope you all have a beautiful day. Take care.